The US Federal Reserve has held its benchmark interest rate steady, and while that decision plays out in American markets, its effects reach far beyond US borders. For emerging economies like India, a Fed pause is never a neutral event. Here is why it matters. When the Fed raises rates, investors tend to pull money out of riskier markets and park it in higher-yielding US assets. That outflow puts pressure on currencies like the Indian rupee, making imports more expensive and tightening financial conditions across the developing world. A pause stops that drain. It removes one source of pressure on the rupee and can lend the currency some stability against the dollar. But a pause is not the same as relief. Prolonged uncertainty about what the Fed does next keeps global investors cautious. They sit on the sidelines, waiting for clarity. That hesitation slows the flow of foreign capital into Indian stocks and bonds, markets that depend on outside investment for liquidity and momentum, so the pause cuts both ways. The Reserve Bank of India, India's central bank, is also watching closely. When US borrowing costs stay elevated but unchanged, the RBI gains some breathing room. It can assess its own rate decisions without the immediate fear of triggering a sharp currency sell-off. But that flexibility is fragile. If global conditions shift quickly, the window can close just as fast. There is another channel worth tracking: oil. A stable US rate environment tends to keep the dollar relatively steady. A steadier dollar generally supports more predictable oil prices. India imports a large share of its oil, so when prices ease or hold flat, it reduces the country's import bill and helps keep domestic inflation in check. That is a meaningful indirect benefit from Fed inaction. The broader point is this: Fed decisions set the tone for global risk appetite. A hold, rather than a cut, signals that US monetary policy is still cautious. Global financial conditions remain relatively tight by historical standards, even without an active tightening campaign. Markets are now focused on what comes next. Upcoming US inflation data and public commentary from Fed officials will be closely parsed for any signal that a rate cut is moving closer. A cut would shift the calculus significantly, loosening global financial conditions and potentially drawing more capital back into emerging markets like India. For anyone tracking Indian equities, the rupee, or cross-border capital flows, the practical takeaway is straightforward. Watch US inflation data first. It is the single most important input the Fed is weighing right now, and it will shape how much room emerging markets have to breathe in the months ahead. This briefing is brought to you by First Financial News, clear daily coverage of the economy and markets, at firstfinancialnews.com.